Hey everybody, welcome back. Peter Lassar here, and in this very important episode, we are going to cover something new, which is our first of many to come quarterly macro reports on where the restaurant industry is and where I believe it's going for the next quarter or two quarters. And it's really important when you are trying to understand the macro conditions and how they might affect risk and how they might set you up for investing into some upside opportunities, that you follow macro consistently. Okay. When you sort of jump into a number here and jump into a number there, and you sort of do it once in a while, you can't really build a narrative for yourself of where you think things are and where you think things are going, so that you can take the best financial decisions possible. And so, making these macro reports quarterly, looking at the most recent data so that we can forecast forward in the next couple of quarters, I think is a great sort of benefit I can provide to you via this channel. So today marks our first of many quarterly reports to come. This is our Q3 2022 restaurant macro industry report, and we're going to get started by sharing my screen. Okay, so here we go. I want to start first and foremost in this period of time with Fed policy. And right now we are in a risk off period with the Fed. We've talked about that before. And what that means is that the Fed is trying to get everybody to delever, de-risk, reduce demand in order to tamp down inflation. And we all know that, but where exactly are we? Well, in this headline from June 29th, it says Fed's Mester, who's one of the U.S. Federal Bank commissioners, backs a 75 basis point hike in July if conditions remain the same. And it goes on below to note that this is the highest inflation running at a 40-year high, as we all know. So why is this important today? Well, as we've discussed before, and as you need to keep on top of mind, it is the Fed's job when inflation is extraordinarily high to destroy demand, right? It can't really have much of impact on supply. And so the price increases of inflation are based on what is the balance between supply and demand. And all it really can do is crush demand in the economy for goods and services and bring supply and demand back into some sort of balance. Okay. And that, in effect, will bring us back down to some sort of acceptable levels of inflation, which historically have been right around the 1% to 2% range and not the 8+ range that we have seen recently. Okay. So, as long as the Fed continues to see that inflation is running too hot, or at least the trends haven't changed significantly, and we're starting to see a downward trend in inflation that is acceptable to them, they are going to continue to put a lot of pressure on consumer and business demand. And I want to jump, therefore, right into consumer demand, because that is obviously what is most important to you. So, consumer spending consistently accounts for about 70% of the US economy. Consumer spending consistently accounts for about 70% of the US economy. The way the US consumer goes, the way that the US economy goes. And if consumer spending is growing quickly, everybody's happy. If it is flat or falling, everybody is feeling some more stress. Okay. And so that's really the point for restaurants that's so central, and that is what is happening with consumer demand, because most of our demand comes from consumers and not from businesses, except for maybe in some of our catering businesses. So if you look at the Bureau of Economic Analysis report for May 2022, this is their most recently released report. The personal consumption expenditure okay, our real personal consumption decreased for the first time this year, and in this case by about 0.4% to the down. Okay, and this is what I believe is a transition to a series of negative months or flat months in the months to come, where we are starting to see the impact of inflation, of interest rate hikes, and perhaps of quantitative tightening that's coming from the Fed to push down U.S. Consumer spending. Okay, and why is this so critical for restaurants? Well, it's critical because we've all been dealing with the expense side for so long, right? Our cost of goods sale and labor, in particular, have gotten sort of out of whack, right, for what we're normally accustomed to, and now we're heading into this transition period where prices should be getting a little bit more stabilized. Okay, they still might be running a little hot compared to the previous year, but within a realm that we are now accustomed to dealing with. But we are not have not been accustomed to dealing with decreases in consumer spending and therefore decreases in restaurant spending. And I believe that's what we're going to see in the next 6 months. In fact, many restaurants that I speak to have already started to see that flattening or even a decrease in the last couple of months, and that trend should continue more broadly and more deeply in the months to come. Okay, now why have many restaurants not felt year to date, this decrease in restaurant spending? And that's because overall it still hasn't been there. Okay, and if you look at this Bureau of Labor Statistics data on food spending away from home, well, from April to May, it increased by 0.7%. That's about 10% run rate per year. So even in April to May, it was still increasing, okay, at a rate that was equal to or slightly above inflation. And so many restaurants have not been feeling that pinch from April to May, right? But actually, this is now starting to change. We're just sort of at that peak where things are starting to shift in the other direction, and I expect that this food spending away from home number will start to be a lot more conservative, and consumer spending will start to go negative, as we talked about, and you're going to start to feel that your revenues are now not holding or at least not growing anymore. Okay, in the months to come. Now, there are indicators of a reduction in spending that are going to be a little bit longer term, and I want you to understand what those indicators are so that you're watching for them in the news. So, U.S. home sales slide as prices break above 400,000 for the first time. So, and right below it says existing home sales fell 3.4% in May. So much of U.S. wealth is tied up in home ownership, and when home prices start to fall, consumers start to get more conservative, right? And home prices don't fall for a month and then go right back up. It tends to be a longer term trend of they're going up and then they start to come down for a period of time, which could be 3 months to a year, right? Before then they start to turn. And so this is generally a leading indicator of what's going to happen with consumption, because we can see that people will feel more cautious because the value of their homes are now dropping. Okay. Ford CFO flags increase in car loan delinquencies. So we're now just starting to see car loan delinquencies starting to increase. We're on the front end of that, and those are also expected to continue to increase in the months and quarters ahead. And of course, that is an indication that disposable income that people have available for other types of things, like non-discretionary expenses, is going to start to dry up. So, paying for your car is a sorry, is a non-discretionary expense. It's basically something that if you need a car, you have to spend on it. A discretionary expense is a restaurant, okay? And when people are having experiencing loan delinquencies on their car payments, which is a non-discretionary expense, it means that they're also even more so retracting from their discretionary or disposable spending, of which restaurants is a lead group for that. Okay. U.S. credit card debt hits an all-time high of $930 billion, with uh, younger Americans having the highest delinquency rate. And it goes on below to say that there's been a $46 million increase in credit card balances in Q2 over Q1, okay, which is just a huge number, okay? It's over 5% in a single quarter. And this is an indication that people's savings started to dry up a little bit, that their expenses because of inflation versus their income started to come into a negative balance, and people are relying more and more on their credit cards. Okay, and so this is also an indication that they're going to be spending more of their available income to pay down credit card debt in the months to come, and less on spending for discretionary items such as restaurants. And so this is also sort of a leading indicator of what is likely to come. Okay, and we're going to get into restaurant specific numbers in just a moment, but I want to show you something that I want you to at least be aware of. First of all, it's not all negative news, right? And the reason I focus on the negative news is I want you to prepare for what could be worst case scenarios. But we have come out of a period of time when the U.S. savings rate has been quite high. There's still a couple, I think, $2 or $2.5 trillion of U.S. personal savings set aside. Companies are generally well capitalized. They generally have relatively healthy balance sheets compared to the past. So there's a lot of good news. But since nobody knows, not a single analyst in the world knows exactly how this is going to play out, uh, my approach is to show you what is likely the worst case scenario, so that you can prepare accordingly to mitigate risk. Okay, and we'll talk about that more in a moment. When we are in a period in which there's really high inflation and there's really aggressive Fed policy to change the inflation rate by crushing demand, we move into periods of time when there's a lot more volatility. And so recently I did a video on food pricing, wholesale food pricing, and my message to you was there's a lot of volatility still to come the rest of the year, where prices are going to go up and prices are going to go down. Okay, and I want you to understand something called the bullwhip effect, which is generally used only in talking about logistics and supply chains. Okay, but it really applies to everything. So when you felt that there was a decrease in available inventory of chicken or chicken wings or whatever ingredients you depended on, right? You, as you had access to such inventory, you might have doubled down and bought excess inventory, right? And of course, that took all of that excess inventory out of the marketplace, right? And and swung the available supply back down again, right? And so as restaurants or consumers are facing supply crunches, what happens is as supply becomes available, we tend to buy it down more quickly. That crushes supply according to demand, and then we get panicked again, and then we move into sort of this bullwhip effect, where inventories can sort of bullwhip back and forth in ways that can affect prices and make them more volatile in general. Okay, and this plays out across the economy. So it plays out in terms of your food costs, and therefore your pricing to consumers, where both might need to jump around a little bit more, okay, in the coming couple of quarters, just to adjust for a more volatile period of supply and demand of your main ingredients. Okay, but this can also have play out in labor, right? So you are most likely have had less labor than you wanted to have. As labor becomes available, as the economy softens, you might end up hiring back more positions than you've been able to before, but then demand might drop. You might have to let people go again. And so you might be bullwhipping a little bit more in your hiring practices, okay, in the months to come. And that's also really critical for you to be aware of in your planning as you're trying to sort of maintain a steady ship. Okay. So finally, how does this play out in restaurant demand? Well, this is a a chart that shows us spending in restaurants and other eating places. And this red line that you see, this upward angling red line from left to right, is are the tops of spending on restaurants and other eating places starting back in 2010, which is really when we were officially in a recession. Okay, after the 2008 2010 sort of crisis. Okay, and the red line covers the tops, and so there have been the lines below the red line, that up and down, also had some bottoms where food spending in restaurants went down and went back up and went down and so forth. But I'm trying to show you what the tops look like. Okay. And then we hit 2020, right? And the bottom fell out of the market because of COVID, and it crashed. And you'll see that red arrow down. Okay. And whenever you have a massive crash like that, you tend to have a sort of a V-shaped recovery that might overshoot the mean, okay, or the medium line. And so what happened is then demand shot way back up as COVID restrictions were removed and people felt safe coming out again. And you'll see the green arrow indicating how we overshot the longer term trends, okay? Then we undershot it as volatility hit in with Omicron, and then we overshot it one more time. Okay, what is likely to happen is that we return to the mean. Okay, most longer term trends in periods of volatility will continue to play out, just with more volatile up and down, but you'll tend to return to that mean line over time. Okay, and the difference between where we are today at about $75 billion of spending per month, okay, in restaurants and other eating places in the United States, versus the mean, is about a 9% drop from where we are today. Okay. Now, some of that 9% drop, if it comes, which I'm not certain it's going to come, but if it does come, might come from restaurant closings of some sort. And so that might not necessarily affect you so dramatically, right? You also might be in a market that's doing better than other markets. You might be outperforming others, but you also might not be, right? And my words of advice are to prepare for a drop of 5 to maybe 10% of your revenue in the coming couple of quarters compared to what you did in the previous year. Now, this is likely to play out more aggressively in the more so in Q4 and Q1 of next year than in Q3. Okay, I think you'll see us trending more and more in that direction in Q3. And we don't know how many quarters it will play out. It might play out for a quarter, might play out for 8 quarters. Nobody knows. Okay, but there will almost certainly be a return to the long-term mean in restaurant spending. And if you're not preparing for a drop in your spending, okay, in your revenues, then you're probably not preparing appropriately. Now, the best news would be that you prepare, right, and the drop never comes, or it's not so aggressive. But as you're thinking about hiring, as you're thinking about allocation of your resources, as you're thinking about building cash, right, you need to be thinking about this accordingly. Okay, so when I talked about the bullwhip effect, right, that there's going to be more volatility sort of across the board. What you just want to think of is where is my mean line that I sort of need to continue to prepare for in my revenue and not get too excited if food prices all of a sudden, food costs all of a sudden drop for you because they could shoot back up. Not get too excited if all of a sudden many employees become available and you overhire, right? You need to plan for perhaps a smaller business than you have today for the next number of quarters, okay, on an increasing trending basis. That would be my advice, okay? This is not financial advice. This is for you just to take information in for your own thought process, but it's what the data seems to be telling us. Again, there's good news within the bad news. There are many data points out there. My projections will be wrong. Every set of projections there's always something that's wrong. The intent here is to give you my view of the macro picture so you can put it into your own toolbox and use your own data points to come up with your own best assessment. But being conservative and building as much cash as you can so that as things start to turn around, you are able to invest into growth, right? Would be a smart policy to think about for yourself. Have a great day.